Hi, and welcome to this industrials edition of Sector Spotlight. I'm David Talbott, and I'm joined in the studio with our sector head, Jay Van Sciver. Today, we're going to focus on Trump's policy versus industrials process, a major secular risk. We would love to hear your questions and comments. Please submit them in the comments section below the video player. And with that, I'll turn things over to Jay.
Thanks, David, and thanks for the introduction. We spent a lot of time the last couple of weeks talking with investors on the road, going around meetings. We were in San Francisco, California, all around the East Coast as well. So just sort of going around and talking to investors, we got a good sense of where consensus is and what some of the concerns people have are. And one of the things that became very clear is there's a lot of uncertainty about policy at the moment, as you would expect, right? So are we going to have enormous tax cuts and accelerated depreciation of equipment or expensing of equipment? And will that result in a big boom to industrial companies? Should you buy cyclicals? That's sort of the key question when you're looking at companies like Caterpillar that could sell a lot of additional equipment in that sort of environment. So policy uncertainty was sort of the main takeaway from those meetings, and we wanted to give some of our conclusions about that and some of the risks presented by the policy changes today. Another thing that comes clear is that many true industrial experts, people who actually invest in these companies, are sort of tired of the bubble in manufacturing experts that are constantly talking on television about what ails American manufacturing. As we'll see from a margin standpoint, there isn't much at the moment, or for the last couple of decades, that has really ailed American manufacturing. So let's take a look at some of the recent data. What we've seen is actually a pretty significant improvement in industrial activity, really into I guess December and January. A lot of this is global in nature. We see, if we look at the next one, we can look at, that's rail traffic. So rail traffic's a great coincident indicator, but rebar prices are a good indication of what's going on in China. And if you think about the industrial recession that really started in early 2015, a major driver of that was lower commodity prices, right? So we did an analysis for looking at the amount of what we call commodity-related capital equipment that was purchased by global, industrial company customers, and it was very significant. And when we saw oil prices, copper prices drop significantly, we saw that CapEx drop off, and without that CapEx, we saw a decline in industrial revenues, and that was a major underpinning of the industrial recession. Stabilization in commodities prices, in part because of some rebound in activity in China and other markets like that, has been helpful in terms of stabilizing industrial activity. It's better. It's certainly not going gangbusters, but it is clearly doing a little bit better. If we look at the actual performance of the sector, however, what we see is it's significantly reflected in performance. So the blue line there is the ISM New Orders Index, a pretty good coincident indication of industrial activity. What's actually going on, and the red line is the industrial sector, the S&P 500 Global Industry Classification, or whatever they call it, relative to the market, which is what a lot of, if you think about the average long-only manager in the industrial sector, they're going to be benchmarked to the S&P 500 GIC, and their PM is going to be benchmarked to the S&P 500. A lot of money is benchmarked to the S&P, so it's probably worth looking at those on a relative basis at least. Now, if you think about one thing we like to do is just sort of put two standard deviation bands around the industrial sector relative performance, right? Because realistically, as Keith says, two standard deviations is where interesting things tend to start happening. And if we look at the industrial sector slide with the relative performance in the two sigma bands, we can see that particularly after the election, the optimism about the Trump administration and a Republican Congress and potential work they can do together really shot the sector up well outside of its two standard deviation bands. And it has since come back into those bands, but remains very elevated, certainly the highest in the last few years relative to the markets. We saw significant industrial sector outperformance in the wake of the election. That's what really created all this. Part of that's better industrial activity, but mostly it seems related to the election. So we need to ask, is this recent move going to be justified by policy changes that the administration is actually going to make? And when you go through, sort of the first order consequences, like they're going to cut the corporate tax rate to 20%. Oh, well then obviously this is great, right? Assuming they're profitable and they pay taxes in the U.S., you'd see taxes, obviously after tax income go up. But what you instead see in the tax plan, and we have a policy group, Potomac Hedgeye Research is a great resource. Having your own in-house policy team, if you are an analyst, is something is a privilege I haven't previously had before. We have a defense analyst, we have a macro policy analyst who can answer these questions. And one of the things that becomes very clear from their input is that a version of the speaker's Paul Ryan's plan, a better way plan, is what is the blueprint for tax policy reform that's out there at the moment. And there's a lot of ins and outs to that that have very different effects on companies depending on, for example, do they import a lot? Do they export a lot? Do they have a large amount of debt with interest expense? Because some of the policies that are specified, if you haven't read the plan, it's 35 pages. It's very interesting, very compelling. We're not political, so I don't want to say like, I love the plan, I hate the plan, I'm not interested in that. It does do a lot of very interesting things. It's a very different tax framework than we have currently. So if you haven't taken the time to read it, it's a better way, and you should definitely read it. Because one of the things that happens is if you buy a tractor, for example, John Deere, you can expense the tractor in the first year, whereas typically you depreciate it over a number of years for tax purposes. So that pulls the tax benefit forward relative to the current policy. But at the same time, if you finance that equipment, your interest cost is no longer deductible for tax purposes as I read the plan. We'll find out if it's phased in or what the actual mechanism is or if that particular component survives. But what's written in the A Better Way plan is you don't get to expense that. So if you model it out at a 20% tax rate, that has basically a full negating effect to any benefit from the accelerated depreciation, or it's not even depreciation at that point, it's just expensing of capital investment. So you want to pay attention, I think, very closely to what the specifics are. One thing that we did do is we went back in a note for clients and we looked at how our process in the industrial sector plays out in this kind of environment. So one of the things we do, and Talbott is very good with data next to me here, is we look at what we call fleet demographics. So we spend a lot of time looking at the ages of things, and we'll touch on that in a second, but it is something that I think dominates tax policy. But one thing that we just want to say, right at the beginning, again, we're not political, but I think it's worth noting on the next slide that if you are an industrial sector investor, even though we hear a lot about the decline of US manufacturing and all of the problems that have come our way, and it has been difficult for labor, so I don't want to minimize that. But for the actual industrial sector over, say, the last decade, or in this case, 2 decades, NAFTA and China's entry into the WTO and whatnot have been not bad at all for margins. And this is true for many, more manufacturing-oriented sectors, maybe, utilities. You can do it by different sectors, like utilities margins have gone nowhere. Industrials margins have increased. And if you actually look at the numbers on that, that's 4x. So they went from, basically high single-digit operating margins for the industrial sector in the S&P 500 to about 40%. That's a big gain. Now, some of that's mix, and some of it's problems with the S&P weightings and whatnot. But the reality is, it's pretty obvious that margins across industrial America have expanded. So there's no problem with policy for investors. I think that's an important takeaway. And anything that sort of threatens that margin progress should be pretty alarming to investors. So we can look at sort of the different factors that have allowed that, right? So, we all know about sourcing and the China price and things like that. That's definitely been a factor, right? We've definitely seen the sector source and keep a lot of that through prices. We've seen some consolidation. We spent a lot of time on water heaters recently. Great example, A.O. Smith basically consolidated on the residential side, on the retail side, a duopoly between A.O. Smith and Rheem, right? That's something that has allowed them to expand margins, particularly in the last couple of years. And then there's Bradford White, which is on the commercial side, on the selling to wholesale. And so there's been many factors driving margins higher, but one of the ones I think that we should just not to be political, but I think we've clearly seen substitution of capital for labor in automation, and more commonly, I think we've seen, it's true, offshoring of jobs. For example, those water heater manufacturers like Rheem make their water heaters in Mexico, and then they import them into the US. And what we've seen is a decline in manufacturing employment on the next slide that correlates very well with the expansion in industrial sector margins. So labor's going down, revenues are going up, and margins are going up. So if we see manufacturing policy that can bring production back to the US, we could see a pressure on this trend, because the reality is that US labor tends to be higher cost. It also tends to, if you force manufacturing to occur in the US, it brings about the potential for increased unionism. And one of the other factors that has helped industrial sector profitability has been a decline in the influence of labor unions in the US. If we look back at, I think we do in a couple slides, we look at sort of the pressure that, talking about John Deere, saw again, of a strike in 1987. So typically, if you're a cyclical industry, when things get bad, you can't treat labor as well because things are bad. And then labor gets unhappy and they tend to strike, perhaps understandably, at the worst point in the cycle. So 86, 87 was the, pretty much the trough of the ag cycle for ag equipment. And it is, it was very painful for them. And we have that quote from the annual in a couple slides. Border adjustability and trade is also, the impacts on the sector are very disparate, right? So if you think about what is the border tax adjustment, border adjustment tax, adjustability tax, right? It is principally, if you import things, right, that is not deductible for income tax purposes, like interest. That's a big change. And if you think about the amount of components that are sourced into the US, it may not even be direct. It may not even be that Caterpillar is buying directly from a foreign supplier, but the supplier they're buying from that might be domestic, might be sourcing components or steel in the supply chain from foreign sources, and then re-importing them. So that creates a very difficult framework in which to start to try and analyze the impact of this on individual companies, because it's very hard to say what the foreign content is on individual companies. As we understand, for example, John Deere, as they calculate it, import a lot less than they export, so they're probably a net beneficiary of this sort of a tax, because exports have no tax. And then if we look at other complications you can get, if you borrow in US dollars to buy a foreign company, is that, if you borrow domestically at a corporate domicile in your say your US domicile company, borrow in the US, you take the cash you borrowed and you buy a French rail equipment company, is that interest expense paired off in the US or externally? A lot of subtleties like that make an enormous difference in how it impacts EPS, and are things that will need to be resolved as this tax plan is understood better. And then there's also just a secondary impact on trade. So for a company like John Deere, a recognized vulnerability that the US has in terms of trade is agricultural exports. We are an exporter. We're a great producer of agricultural products. We export them. We're a net exporter to a lot of countries, Mexico included. They have a GMO restriction, a variety of other things that allows us to export there. And Deere is not happy about things like TPP coming apart. So it is a very complex series of policy changes. There's an initial response. This is all positive, 20% tax rate, good for US manufacturing, America first, right? It may be good for US manufacturing labor, but the existing policy is not at all bad for US industrial investors that have outperformed. I think we outperformed by 20 percentage points the sector since, when was it, the Bush inauguration? I don't know, we put it in there. It's outperformed pretty significantly over the last decade and a half. So what works? How do you handle this? If we look back at John Deere in the 1980s, right, In 1980, 1979, we spent a lot of time looking at fleet demographics, right? We had a very young fleet. Everybody just bought a tractor. If everybody just bought a tractor, they're not going to buy a new tractor, right? One thing that we can usually say is that people don't buy superfluous industrial equipment. Nobody's like, oh, I want an extra locomotive because it's awesome to have spare locomotives. It's not like buying an extra shirt or an extra car or whatever, right? There's no joy in having that like extra locomotive in storage. So people don't typically buy things they don't need. Tax incentives aside, you can't really incentivize somebody to buy a piece of equipment they don't need. A railroad may, have more total capex as a result that they can expense. So they might build an extra, they might double track somewhere or wherever, but they're not going to buy equipment they don't need. So if we look at Deere through the 1980s, it underperformed right through the Reagan tax reform, right through the Reagan tax cut, and actually took from 1979, it actually bottomed out on an alpha basis in around 2000, August of 2000. Took a long time for that to work off. And that is in part because of the strike, which actually coincides with the low in the stock in 1986, and in part because just the fleet demographics said people don't need tractors, right? If people don't need tractors, they don't buy tractors. So one thing we want to stick with in terms of our process is sticking with sort of the three components we have. One is just sort of understanding the replacement cycle, the long cycle in the industry. Second is industry structure, and third is valuation. If we have richly valued industrials that have very young fleets, not in need of a replacement cycle, if you're going to go into like an equipment aging cycle, it is probably a pretty significant negative for the group, and vice versa. So we don't necessarily need to adjust too much to policy on this one. In other names, so like one of the names we have as a long and sort of the policy side is Textron. So if we think about the impact of lower corporate taxes, and particularly lower partnership taxes and the elimination of inheritance tax and the distribution of the tax cut, it overwhelmingly, I think, supports potential users of private aviation. Probably good for them. Also, the Trump administration and Congress has targeted a pretty significant increase over time in defense spending as a priority. So we'd be looking at a company like Textron as in sort of the sweet spot. They make private jets and military equipment. Of that kind of a policy shift, potential significant revaluation, a name like that. Labor coming home, also potentially good for automation suppliers and whatnot. And then there can also be some areas where maybe the impact is misunderstood. We're looking at some of the rails that way. So what is the upshot? Like, basically everybody out there is wrestling with a mixed bag of policy issues. Some are deeper in it than others. The first order effects, though, I think most are wary about extrapolating. The lower tax rate is generally good, all else equal. I think that's a pretty clear conclusion. But income is defined a bit differently, especially with respect to imports, exports, and interest expense. And you may see a significant move in costs. So the margin contraction, that steady margin expansion we see, if we see that reverse, that is the kind of thing that can come from higher costs, which may come from the inflationary pressure or something like the border tax. Any kind of trade disruption, labor concentration, supplier concentration, because look, if you have to manufacture in the US, that's a lot harder. So far, the leverage we've seen the administration take is focused on places where they have big customers. So like the federal government is a big customer of Boeing, right? So they can go and bully them, right? But it isn't necessarily a new tax structure. If it's extended, it has a lot of potentially margin compressing for investors impacts. Positive for labor, not necessarily for the equity. In terms of sort of the net effect of who wins and loses, the actual effect is, I think, a bit complex. It's going to be a dynamic system, and it's not straightforward. So you could find yourself, a little bit down the line, and suddenly we are in some sort of a trade skirmish with China. And I think probably avoiding some of the most vulnerable areas or the targeted areas that we have for trade is probably reasonable. Sticking with some of the clear policy winners that are reasonably valued anyway is probably also a good strategy. So like Textron is our sort of name with respect to that. And with that, we'll take questions. It's our first sector spotlight, so it's not perfectly organized.
Sure. Yeah. Thank you, Jay. see here. Does the Dakota pipeline news have any impact?
So Dakota pipeline was 90% completed. Over time, investments in resource infrastructure tend to be deflationary, right? They tend to lower commodity prices. So I think probably not. I think what the person who's asking that is probably getting at more broadly is, will it matter if we fast track infrastructure investments in general? And that is the kind of thing that can have an impact, although it tends to be slow. Like, these things take a while to actually ramp up. And infrastructure in general is a very interesting topic, right? And we're likely to see over time an infrastructure bank, but according to our policy guys. But that is the type of thing that is not fast to happen. And in that specific instance, it's pretty, in terms of the actual equipment and spending, it's pretty far along.
Okay, yeah. Do you guys still like John Deere as a short? Any catalysts coming up?
I do. I think there's a lot of structural problems with John Deere. I think, one, a lot of the favorable decrementals they reported relate to lower input costs, and particularly as we head in through the first and second quarter, we're going to see very tough comps on input costs, right? So higher steel. What's a tractor made out of? It's not made out of donuts. It's made out of steel. And steel prices fell a lot, and they had great decrementals. And you know what? So did every other industrial companies. The whole sector had pretty good decrementals through the second half. And I think as we get into the first half, we'll see those decrementals see pressure. You also had a pre-buy in Brazil. If you actually look in the numbers for Deere, you'll find that as we whack it up, Brazil was a big factor in fiscal 16 results. And obviously, post pre-buy busts come, right? So that type of, if people pre-buy ahead of new emissions regulations in Brazil, after they're implemented, they were pre-buying for a reason, and they don't generally buy afterwards. And then finally, I think with Deere, what we've seen is increasing past dues and other pressures within the finance subsidiary that makes up 35-40% of net income. So most finance subsidiaries at manufacturing companies don't make up over a third of profits. So if you see pressure there, there's some very aggressive assumptions, in my opinion, that go into generating those profits. And as we know, with financing things, the negative consequences of easy finance hit on a lag.
Okay, yeah. I guess sticking with the raw materials costs, are manufacturing companies stocking up on raw materials in anticipation of higher materials costs, switching from foreign source materials to domestic?
That's a great question, and one I have. So what we did see is after the election, it was a big jump in orders, right? And if you look at inventories, they went up a little bit, right? So you saw kind of a trend towards falling inventories. And if you were in it, which a lot of people weren't. I mean, so we had the election, Trump won, the market was down like 800 points, it reversed, everybody was there, right? So a lot of people hadn't read the tax plan, but my guess is most manufacturing CEOs were well prepared for it, and they may, or certainly the next day they read it, and they may have said, like, look, we're going to have tax reform that's retroactive for 2017. Let's put our orders in December of 2016 because God only knows what these imports are going to cost next year. And you may have had a little bit of a tax change front running, and if so, that would be smart, I think, on the part of the CEOs who would have done that, or purchasing managers. The answer is that there's a little bit of evidence of it, not a ton, but we won't really know. You probably won't know. You won't see it really until the February-ish numbers. So it's a great question. I hope so, because I'd like to think that our management teams are clever and able to front run policy.
For sure, yeah. And then looking at the S&P Industrials margin chart, did industrial margins expand because of NAFTA and China entering the World Trade Organization, or is it because China spent a few $1 trillion building pretty much everything they could think of?
I love that question. Both. Why not both? So China spent a lot of last year not building everything they could think of, right? So we saw rail traffic down pretty significantly, construction activity, Chinese rebar prices, we have the chart in the deck. So margins mostly held up for the industrial sector, not obviously the Caterpillar Resource Industries of the world, but some of them did fine. So it's clearly more than just the complete reorganization of world infrastructure spending to finance the China fixed asset investment boom, which is clearly a big part of it. I don't mean to minimize that, but it's more than that. What we sort of see happening, again, I don't want to politicize it, but one thing that, in my observation happened is, if a plant wanted to unionize, unions lost a lot of leverage with the ability to source in Mexico and China. And unions used to be a bigger deal in thinking about industrial companies than they are today. So if you, again, look at the segment from the 1987 John Deere annual report, right? Like, it mattered that they all went on strike, and they got a lot of increased wages. Basically, the leverage of labor used to be a lot higher when trade agreements were weaker. So that's a factor. Or just even the ability to go and source, right? Like, so I used to build a component in the US, but now I source it from China. Really kind of the same thing, right? You're getting rid of a lot of the US costs and basically transferring those externalities and whatnot to the Beijing breather. So I think the answer is that it's both very much. And if you do things that disrupt free trade and Chinese growth, that's probably industrial sector negative. If you do things that increase the bargaining power of labor or make it harder to seek alternative sources of goods, right? So also just think about how much that concentrates your supply base, right? If you have to source in the US, if you had to buy water heaters only from a US-based manufacturer, not the guys who make it in Mexico, that would be hard. You're stuck with Bradford White, right? I think A.O. Smith, I don't remember where A.O. Smith, but you're narrowing your supply base. You're giving them leverage over you in a way that they didn't have because of free trade and lower tariffs. So I think the answer is both, and that free trade has clearly been okay at least it hasn't been bad for margins.
Okay, great. What are your thoughts on M&A for the industrial sector given the Trump presidency?
These are great questions. So in the case of M&A, I think one thing that is clearly going to happen is that, according to Paul, our policy guy here, who spends a lot of time doing some very interesting work, although sometimes it's a little hard to access. His sort of takeaway was that antitrust is going to be easier, and deals are likely to get more extreme in terms of what would have typically been not even able to be considered. I forget, it was Verizon Charter, right? Was the merger he threw out. Hey, maybe a Trump administration with less antitrust restriction would actually consider that. That's a really different world. Could we see rail mergers come back into the fore? I think definitely. I mean, you saw, all these people are, Hunter Harrison leaving CP isn't related to the election. Really? I mean, that's the king of consolidation there. He leaves his job, has a very complicated series of agreements, gives up some money to do it. I gotta believe the guy's got some sort of grand finale for his career up his sleeve, and it probably relates to consolidation. That's my take on it. I've had NSC, I think, well-timed, best ideas long. So I think you're going to see consolidation. I think it's very hard. And I think if you're a short, that's something you want to definitely stay away from, things that are going to get consolidated because, why not? I mean, so Paul Glencher, our sort of law guy, was like, yeah, people are just going to throw these things out. Why not? Why not try and, consolidate your industry? The worst that the FTC is going to say is no, and odds are they might say, it seems like we're moving to very limited antitrust. It's not like an immediate no and everyone's going to hate you. It's going to be yeah, sure, why not? We'll give it a shot. So I think that's a big structural change. Okay,
yeah. Moving on to Textron. Textron makes Bell helicopters, and it was a drag on earnings last quarter. Was wondering if Bell helicopters are used in the oil field platform space. Thinking a resurgence in oil might help the unit out.
Definitely. So helicopters, end markets are like, municipalities, really rich people, and I think Blade, democratizing helicopters. And then obviously energy is a huge market, energy and mining in general, because you got to get workers out to oil platforms quickly. Big market, especially for by maybe not always as much by units, but by dollar value, because they tend to be larger helicopters. So there's a variety of markets that are impacted. Energy, it was actually a reason why we did it, because oil prices were down a lot. Helicopter deliveries are down. We had already seen the impact on deliveries from the decline in oil, which makes it sort of a safer time to enter the name. So that is definitely a positive for them.
Yeah. And follow up to Textron, how much of their mix is related to defense spending?
We have a pie chart somewhere. I think the key part for Textron on defense is how much growth that they have there is actually, it's going to be, so currently if you think about, like when we go and we talk about Textron to PMs, you always get don't they make golf carts? It's like, yeah, they make golf carts. They make the Easy Go, and they make plastic gas tanks and lawn mowers with Jacobson, and they have kind of this history of having taken like golf courses as collateral, and it's kind of a mess. But I think one of the things that's happening to Textron, and I think maybe their management gets a bad rap, they've, I think, done some very good long-term strategic planning that will benefit the next management team probably, is they've created a great growth platform for their military business. So the Future Vertical Lift contract is we call it the Joint Strike Fighter of helicopters coming their way. Very interesting program. I know it's far out, but realistically, markets price things in that are far out. We have visibility. Army's helicopters are old. They will be replaced. The Army will have helicopters, and Textron is quite likely to win, according to our defense policy team. Then Ship-to-Shore Connector, another big project. Scorpion is apparently a total mistake to spend money on, never going to win. I don't worry that much about it. It's a small program, we'll write it down. But there's a variety of these programs, the V-22 remanufacturing to get it to a common configuration. There's a variety of these things, and the mix is going to shift heavily towards defense. Even before the Trump administration, it was heading that way, because these are visible future contracts. Unless, of course, they sell a lot of private jets, which with the elimination of the inheritance tax and partnership tax rates coming down to 20% instead of 39%, they might sell a lot of private jets. They might actually end up, in which case that's fine. I don't care where they make their money.
Awesome. Well, that's all the time we have today. Thank you for tuning in to Sector Spotlight. Another live segment will occur next Tuesday at 2:30 p.m. We hope to see you then. Thank you.